Thanks for tuning into this episode of Navigating Through Uncertainty. A note written on October 15th, which came to my inbox, I think on October 17th, caught my eye. It was written by Jeetu Panjabi and Umakant Sharma of Capital Advisors. The title of the note was Belt Up for a Coming Global Supercycle and a 100 Trillion World by 2023. Well, we requested the author of the note to come and share with us his thoughts on the world as he sees it. And Jeetu Panjabi joins us today to talk about that and more. Jeetu, good having you. Thanks much for taking the time out. Hope all is safe.
Thank you, Neeraj. Appreciate having me on the show, and good wishes to all the viewers of this show to be safe and well.
Yeah, indeed. That's more important, I reckon. But let's start off with your thought in the world as you see it, Jeetu. Before we get that big picture perspective, just a bit of a comment on, because the show is called Navigating Through Uncertainty, about the slight uncertainty surrounding us, considering the fact that one, we have a big major event, the US elections, and two, we seem to be, at least in the Western world, seeing a bit of a wave two of COVID-19 cases moving up. And is that clear and present danger?
It's really, so I'd agree with you. There's a clear and present danger driven by both these events. And we flagged both these as risks to our thesis on the note. But I'll give you two aspects which I think you put in perspective. So one, the near term is very, very difficult to predict. But the minute you go out and you look at it from a longer term perspective, you look at it from a 2-year, 3-year, 5-year, 7-year perspective, and all our analytics goes back 50 years, starting from 1972. And what we see is there are very, very clear patterns at work, and a lot of the near-term stuff is noise. So what we try to do is we find opportunities in the middle of a crisis where it sounds like, oh my God, the world's going to end. And we realize there's a pattern that's going to play out if you have a 24, 36-month horizon, and we capitalize on that. Now, coming to the 2 points here, is there a concern driven by US elections? Absolutely. Is there a risk that Biden comes? And I think the biggest risk if Biden comes is he takes taxes up. He's going to make it a more sane world, a more multilateral world in a way, in my view. But is there a risk of taxes going up? If he comes, absolutely. Do we have a clear roadmap on this? The answer is no. So are you going to see markets getting worried depending on how the rhetoric flows and what plays out in elections? Absolutely. Having said that, my view is this is an opportunity if that plays out, right? So we've seen the last few days, markets have gone down a fair bit, people are concerned, and we were positioned for that in our thinking as well, saying that, look, the markets are going to correct because markets want equilibrium. Markets don't want disequilibrium. Markets want certainty. Markets don't want uncertainty. So in that framework, the way we think about it is that there is uncertainty, it's creating opportunity. We capitalize on it. But having said that, there clearly is a risk that Democratic government comes in and takes taxes up, surpluses in corporate pools reduce on the margin, and there are risks to markets. But we don't see that's a risk beyond 12 to 24 months. We think that's a near-term risk. Your second point on the cases, new cases coming out, and I just go back to data and see, look, it's really sad when you look at the data. Globally, the world was adding 100,000 cases a day in April. Today, the world is adding 500,000 cases a day. And it's really sad to lose a life. But the point is that in April, the world was losing 6,000 lives. Fatalities was 6,000 a day. As cases have gone up 5x, fatalities still 5,000-6,000 a day. So the point is, fatality rates or mortality rates have gone down, driven purely by COVID. People have understood how to navigate the world and manage with COVID. And I think the path I'd say is coexistence with COVID is something the world is learning to live with. If I live in Bombay and I step out on the road and I see the amount of traffic is pretty much what it was a year ago, I don't feel happy about it, but I see the cases in the last 4 weeks have gone down and fatality rates have gone down even more. So it's a new world. You need to figure out how to manage through it. I do worry about it, but I think the economic side will normalize at a point? Is it 3 months? Is it 6 months? Is it 9 months? I don't know. But we feel pretty optimistic that both of these are risks, near term, but there are opportunities from market standpoint near term too.
Okay. So let's talk about this opportunity. The bedrock of you saying that this could be an opportunity is your belief, I presume, that there is a brand new global super cycle, which according to your note was born last quarter. Now, what's the basis of this argument? Because I would reckon, Jeetu, and please correct me if I'm wrong, is that you would be at the throes of a super cycle or in the midst of a super cycle if the end aspect, which is demand at the end of the consumer, would be alive and kicking and getting stronger. How do you read into that? And therefore, what's the argument for the global super cycle?
Okay, so let's back up. Let's first ask, how do we define a super cycle? In our simple analytics, if the world's growing at 8 to 10% in nominal dollar terms, that is a super cycle at work. We've seen this before. We saw this in 2003, 4, 5, 6, 7, when the world went from a $33 trillion world to a $61 trillion world. The world size of the world in dollar terms went up over 90%. And the drivers of that super cycle was, one, it was a synchronous world. Two, China emerged out of, with large growth rates. Three, the trade integration with the world happened. So all of that played out concurrently, and we had a large super cycle. We had a couple of years of 8 to 10% growth in 2010-11, as well as we came out of the 2009 crisis. And the view is that the 8 to 10% growth range we will hit in the next couple of years as well. Okay. Now, why is that relevant? So I go back 20 years and I say, what's the world grown at in real terms for the last 20 years? Well, the answer is what? It's give or take 3%, right? So does it matter? I've heard very, very, very prominent Indian CEOs come out and say, oh, I just came back from Davos, from the World Economic Forum, and I figured the world's going to grow at 2.7 to 2.9%. And then the next year, the guy comes back and says, oh, I think, the world looking good is going to grow at 3 to 3.2%. And my answer is, so what? Right? And just a case in point is 2015, the world grew at 3.3% real. And in nominal terms, the world shrunk by $5 trillion. And that was the title of our note in 2015, saying, honey, I shrunk the world by $5 trillion. So it was a horrendous economic scenario. But the IMF and World Bank and all the good data out there said the world's fine. Now, which is the point I'm making, that the world has grown at give or take 3% plus or minus 50 to 75 bips for the last 20 years. You don't read big cycles into that. The big cycles are read into nominal data. And the two difference between real and nominal is the deflator and the dollar. And the deflator and dollar has much more information than just the real data. And the point I'm making is that the world in April had shrunk by $9 or $10 trillion. In our estimate, we get that back plus a lot more. The drivers to this deflator plus dollar going up over the next couple of years is the monetary policy and the fiscal policy of the developed world. And that's going to be in high gear till your point that the consumer is going to come back. So till the consumer comes back, you're going to have fiscal and monetary policy in high gear. And as that plays out, the consumer comes back. But in the interim, you have a deflator that's going to go up 3 or 4% per annum, a dollar that's going down 3-4% per annum, and you get a real GDP of 3-3.5% once the world normalizes, and you have an 8 to 10% nominal dollar growth in the world. So you get to a point where the world looks pretty good, and no one imagined that's going to happen. But the driver of it is not the real GDP numbers, but the nominal aspect of it, and that's a big deal.
Okay. Do you think the work put in by the central banks and the monetary policy thus far is good enough to take us through those next 2 years? Because we know that the fiscal responses, by and large, have been a bit sedate, if you will, at least in India, maybe, and we'll come to India in a bit, of course. But I'm just saying that we've seen largely action taken by the central banks, but maybe they are running out of firepower as well. Do you, and there are, of course, arguments made by a lot of people who, quote unquote, are slightly pessimistic, is that because of the things that the central bankers have done, we might have a case for a bit of a doomsday scenario for gold, Bitcoin, etc., to do very well. So your theory is completely the opposite of what some of the others are saying. Can you explain that?
Okay, so very fair point. Right? IMF came out with a note 10 days ago, I guess, painting a very pessimistic scenario. They said the world's going to take a couple of years to normalize in real growth terms. I fully agree. But their perspective comes out of linear conventional economics. And linear conventional economics told me the world's grown at 3% for the last 20 years. This has not given me any new information. And I'm an equity investor. It's useless. That data is useless to me, right? It doesn't help me create an analytical framework. I've heard Ashwath Damodaran tell me in an intense discussion saying, look, there's no correlation between economic growth and equity markets. And this is a little secret of ours. This was about 18 months ago, and I didn't tell him, look, you're looking at the wrong metric and you should look at it a slightly different way. But fair point. So that was just more in jest. But I have a lot of respect for Ashwath Damodaran, and he's
everybody does.
A fantastic guy, right? But sort of the point I'm making is when you look at it through the lens of linear economics, conventional economics, you get the answers that was in the IMF note. The world looks pretty pessimistic, right? Now you come into kind of saying, are we going to run out of monetary policy? If we were going to run out of monetary policy, Japan would not be able to do what it's been doing for the last 15 years, right? Japan would have run out of a balance sheet, central bank balance sheet capacity, would have stopped doing what it was doing. So what did Japan do? Japan said, we're targeting inflation. We're going to keep doing this till we get inflation, okay? And I think now the point is, in a world where rates are close to zero, either it's 20, 30, 40 bips or negative 20, 30, 40 bips. The point is you can keep doing this for a very, very long time. And in my view, there's a path to coming out of this as well, which is again in the realms of unconventional thinking and lateral solutions. And I've had discussions with BOJ informally on this in the past. But the point is that the US is targeting an inflation number. So you're going to have an inflation number where you have income, only when you have incomes and jobs. And when you have incomes and jobs, you have the consumer coming back. When you have the consumer coming back, you have inflation coming back, and monetary policy can keep running along till that happens, okay? No one thought that, everybody thought a $2.5 trillion balance sheet, Fed balance sheet is too large. Well, guess what? It doubled in 6-7 months, and it didn't matter. Nobody's worried, and things are coming back. So in my view, I don't see that as a deterrent for monetary policy to continue. Second point is, as we learned, what the world learned in 2008 was fiscal monetization was legitimized, which was version 2.0 of monetary policy. So you actually printed money and you gave it to the government and told the government go spend. Okay, that got legitimized, and you can see that at work. You see kids in the US who are working there suddenly get a $1,500 or a $3,000 check in their mail. Basically, the US government has been paying out people. In the UK, you saw the same thing happen. So you've legitimized fiscal monetization. The doubling of balance sheet in 6 months is not having an impact on rates or on any clear imbalances. A lot of people are worried about balance sheet imbalances. Is not having a concern on imbalances. So life is going on. I personally don't worry about it. And I'll complete the point. My discussions with BOJ was, look, it's all central government debt in Japan. And it's sitting in the asset side of the balance sheet of the BOJ. Now, the BOJ technically is 100% subsidiary of the government of Japan. So, and cost of that debt is zero. Why not just net it off both the balance sheets? And in private conversations with these guys, they agreed with me. They said, we agree with you, that's the right thing to do. but politically it's going to be hard to digest. So it might be political harakiri. So we just won't do it, but just letting it be there doesn't hurt us. So that's going to continue. My view, there's a way out of this as well.
Okay. But I mean, okay, that's maybe for the time as well, because that's just the basis of that conversation is completely different. I'm just trying to understand, therefore, that am I guessing this correct, that your view, therefore, is that there will not be a catastrophic outcome to all that we're seeing right now in the balance sheet expansion, but a more gradual outcome which leads itself to a global super cycle in your terms? And therefore, what would that mean for the world? What would lead this global super cycle? And how do economies like India play a part in that?
Okay, so the transmission, it's a great question. The transmission of the super cycle is as follows. It's largely the developed world and China, which has been driving the ammo in terms of monetary and fiscal. And the PMIs are telling you that that's what comes out first. Okay, we've seen that it first played out in the demand in the tech world. So the Netflixes, the Googles, the Facebooks, as people sat at home and had higher activity levels, you saw that transmission play out there. Now the world's opening up and people are moving around and slowly trying to normalize. And we can see trucking activity, automotive activity, fuel consumption data. A lot of high frequency data is turning upwards. As that transmission plays out, there's been a lot of what I'd say underestimation of demand over the last 6 to 9 months, and things were frozen. So you need to catch up. As that catches up, industrial activity increases in Europe and US. And we can see that again in the data as that plays out. As that plays out, the transmission to the emerging world, which is the supply base for some of this stuff, for some of the raw materials starts picking up. As you see that picking up, it transmits to the Indias of the world and the Mexicos of the world and the Chinas of the world in terms of exports. And as that plays out, you see an external demand driver for the emerging world. And as you see the external demand driver play out for the emerging world, capital flows runs concurrent to it. So on one side, you've got capital flows coming in. On the other side, you've got external demand coming in, and you kickstart an emerging world. And as all of this plays out, and this can take 12 to 18 months, as all of this plays out, coupled with deflator that's going up and coupled with the dollar that's weakening, which is what we're seeing concurrently. We can see it in the month-on-month data. We're not yet seeing it in the year-on-year data. The year-on-year data hides 11 pieces of very important information, but the month-on-month data is telling you it's already happening. Okay, what I'm saying is already happening. As that plays out and the transmission of external demand plays out, you're going to see the emerging world, including India, doing well. And so it's a path that's already started. It's not something that we think will start at a point. It just has to gain pace. And as it gains pace, you will see it out in the data.
Now, the people that you advise, or you yourself in your portfolios, Jeetu, might be people who actually look at the really long term and invest with that perspective as well. Maybe the desire of the alpha, at least for your clients, would be a lot lower than an average investor would be. So my question is, when you yourself are looking to invest into this global super cycle, if you are you confident enough to put the machinery to work right now? Or do you reckon that because of the uncertainties over the world over the next 6 or 9 odd months, be it elections, be it COVID, or be it other issues, because the world is not prepared for inflation maybe, and everybody talks about how the crop prices are moving up and we may have a spike out there. I don't know what your views are there, but because of those opportunities, there might be better times to put money to work.
Look, so again, in full disclosure, we turned very positive in the last week of March. Okay, we ran some analytics on COVID. We said there's a template for Europe to follow China. Early days, naive work, because there was very little data.
Yeah.
So I would say it was better to be lucky than to be smart, and we were fortunate. We were fortunate to have turned very positive end of March and early April. We've been positive since. We've had concerns over time, saying has it run up too much, and is it too soon? And those questions keep coming up. but we're never great at timing. We just saw our 50-year analytics chart and we said, this is it. Let the market signal that it's got monetary ammo behind it, and we'll ride it. That was a simple analytical framework that we said the monetary policy is going to drive the real world with a lag, and we're not worried about the real world. The world will normalize. People will start living a normal life. They will get up in the morning and brush their teeth and want to eat breakfast and want to have a Coke or whatever. The world's going to normalize. If it takes 18 months, it's fine. If it takes 24 months, it's fine.
Okay.
Now, to your point, are we at a point where we think the market's moved a lot ahead of where it should be?
Yes.
Because I don't know. Okay.
Okay.
Do I think 18, 24 months from now, we see extremely good opportunities? Absolutely. So, we think the tech or the online world has got priced up a lot, but we see huge opportunity in legacy, industrial, and financials. Okay. The financial sector is still 25-30% below peak. We see in our analytics, we see that there might be a little more pain for 2 or 3 or 4 quarters for the NPL cycle to transmit completely. But this is the time to be in financials globally. We also see that, some of the places which are the Canadas of the world and the Australias of the world, where you see NPL, because they're commodity economies, they might have felt greater pain. We're seeing almost no transmission of that pain into the banks in these countries. So we kind of think that when the market's concerned about something and our data analytics tells us we're okay with it, and we see a normalization and a super cycle play out, so credit's going to pick up with a lag, and credit growth is a lagging indicator to the cycle. So as credit picks up in 12 or 18 months, these stocks will be re-rated up, and as that re-rating happens, we think we can make a lot of money on that. That's the framework, and we clearly believe that, and that is our thinking that we have put to work.
Okay. Just trying to think out loud. The one common argument over the last a few weeks has been that a lot of economies like India and maybe Southeast Asia would benefit by virtue of the diversification of supply chains that all of these countries would have to do. Now, with the presumption that we are in the midst of a super cycle, and therefore the growth in the developed world, as you said, would start off and then percolate, would you reckon that the opportunities for these countries would only go up, despite the fact that that on the currency front, if indeed the dollar were to weaken, it just kind of makes these a bit less competitive?
So I think, okay, the 2 parts to the question. Do we see supply chains migrating?
Point number 1, yes.
Point 1, yes. Okay, what's data on the ground? And let's take closer home, India. We're seeing the Foxcons, the Winstrons, the Megatrons, the Pegatrons slowly coming in. They're building capacity. They're getting customer orders. Their suppliers are coming in. It's playing out. It's on the ground. Okay. What is the template for a Winstron, Pegatron, Foxconn to play out? We saw what happened to Vietnam, driven by Samsung. Samsung went into Vietnam and changed the architecture of Vietnam in terms of a supply chain base for the world. You take Yuen and Pao Chen, which make 16% of the world's sneakers. They make over 1 billion sneakers, and they have almost 1 million employees all over the world. You saw how they moved from China to China plus Vietnam to China plus Vietnam plus Bangladesh, and you saw how those supply chains migrated. And today, China is just 20% of their supply base. So my point is, we've seen these shifts over 10, 15 years. I think these shifts are glacial. They don't come and make a huge impact overnight. So as you see that happening, you'll see, 2, 3, 4 years for that to play out. It helps in job creation. It helps in integration levels. It helps on the margin on economic activity. It helps logistics demands. It helps capital, the need for credit and capital. All of these are lagging to the decision that we need to make it work. And we've seen that in Asia. We're seeing that in India now happening. And thankfully, the government's doing the right thing in terms of pushing this to come in, giving production-linked incentive plans, making sure India gets a fair share of the supply base.
Right.
We're seeing a couple of guys in the air conditioning business being a little ahead of the curve in the handset business. So my point is this is going to happen, but this doesn't turn the switch on in a big way overnight. It's a 3, 4, 5-year shift. Having said that, I think the big driver is immediate. The cyclical is far more important than the structural from a demand drive perspective. And I think the cyclical demand pickup will happen much quicker than the structural shift that you're talking about, even though the structural shift is something we're positive about. I think there's one more thing which I'll talk about in this context is what I call geo-neutrality, right? So what I'm seeing is that you don't need to be in a particular place doing a particular thing. I mean, the H-1B need is getting reduced because we can see that if you're going to be working out of your home in New Jersey for a client in New York, you could do it out of India, right? You don't need to be in the US at all. And the marginal shift driven by geo-neutrality is again helping drive income. So I have friends who said, I don't need to be in Bombay. Last 6 months, I worked from my home in Indore, and we have a garden, and we have a large house. Impossible in Bombay for a normal person. And my yoga teacher sitting somewhere in the Uttarakhand taking yoga lessons. The amount of money he makes for a class in a month is more than the salaries of his full family, right? So the point is you're distributing income into tier 2, tier 3, tier 4 India and tier 2, tier 3, tier 4 EMs by virtue of this. And the impact of that is broadening demand. I think this whole thing gains space. Geo-neutrality gains space. The world becomes more flat in a Tom Friedman world. And this continues to, and a cyclical pickup in all of this is going to be driving demand and good for Asia and EM and India especially.
Yeah, that's good to know. My final question, Jeetu, and maybe 2 or 3 tied into one, is this again that I'm guessing that you still mentioned that despite the dollar weakening, the export competitiveness of a country like India too would continue. But my question is that I was reading this note which speaks about how, because of the kind of capacities on the cyclical spaces, steel, for example, or LNG or coal, for example, India will, over the next decade, if the growth is to be there, have to be an import-dependent country on all of these because the demand is just much higher compared to the capacities that we'll be able to create. And at the same time, there is this thought that this whole current account surplus of sorts, or the CAD situation that we have been besieged with thus far in our lives, will change quite dramatically, because even if we can't reduce our imports of gold and oil, because of PLI, electronic imports, etc., might go down. Some other imports might go down. What is your thought on the natural resources picture and therefore the cyclical industries thereof? And tied to that, the larger question of how would the current account numbers and the other macro numbers shape up for India? That's the last question.
Okay, so the 2 questions, the last question, and I apologize, I didn't answer the dollar weakness question earlier. I skipped that. So remember, the other side of the dollar is the rest of the world. Okay. So it's not just India, it's Europe, which is actually a trade partner that's much bigger. Europe as a trade partner is bigger for the US than the US. India as well, a lot of the different parts of the world are bigger trade partners. US on a trade weighted basis, probably on a nominal basis, probably 21% of the world. So what we're saying is 80% of the world, which is the other side of the dollar, appreciates and magnifies the impact of a weaker dollar, which is India. So does our exports to Europe get hurt? The answer is no. Do your exports to some of the Asian countries get hurt? The answer is no. Do your exports to Middle East services, does that get hurt? The answer is no. Is there a little bit of some of the US? Yes. And is US ready to take a little bit of inflation, which really wants as a function of this? The answer is yes. Do we also see productivity adjustments neutralizing some of this currency impact? I think so. So the bit you're working harder, you're working faster, getting better capacity utilizations, You're going to see some of the productivity changes, improvements, neutralizing some of this. So I don't see a big currency impact if India is not the only neighborhood taking a currency up. In my view, the biggest 500-pound gorilla on the other side of the US was China. And China has appreciated its currency by 7%. Now, believe me, that surprised every FX watcher in the world, saying in the middle of a trade battle, you've taken your currency up 7%. That's completely unbelievable, and how that has impacted the world is huge. But the point is that has, in a way, concurrently driven dollar weakness and catalyzed dollar weakness, and it's helped the euro and the sterling and everything else go up a little bit, the yen go up a little bit, and including India, and it's actually helped manage inflation as well broadly for this part of the world, despite the bump up in commodities that we've seen. Now, to your second question, and I guess that's a more medium-term question over the next 2-3 years, do we see a bump up in the current account deficit as this plays out? In my view, the biggest import that India faces from a commodity import perspective is oil, okay, followed by maybe coal, if I'm right, and maybe a little bit on the steel side. The way I would see it is there are structural shifts at this point going around in the energy chain, right? So in my view, energy as a basket of commodities is globally moving from a conventional energy chain to a technology food chain. Under the technology food chain, Moore's law becomes applicable. So from a solar standpoint, from a battery standpoint, from various other new technologies that are coming into play. So do we see prices of oil and the energy chain staying capped? I believe so.
Yes.
Okay. Are we going to see increase in imports over time as the economy picks up? Absolutely. Are we also going to see exports pick up as the world expands and the super cycle happens? Are we going to see two-wheeler exports pick up? Absolutely. Are we seeing car exports going to pick up? Absolutely. There's a lot of other stuff that India exports in terms of services and pharmaceuticals and IT and stuff. Is all of that going to pick up? Yes. So do I think a 2% current account deficit is good for India? Broadly, I think so, because that's the difference between savings and investment. And if investment is kicking up 2% over savings and driving a current account deficit that catalyzes growth even further, I think it's a good thing for India. Is a 4-5% a nervous zone from a current account deficit? Yes. Do I think the policymakers understand that? Yes.
Of course.
So do I worry about the current account because of commodity? Answer is no. And the answer is very clear. I'm going to preempt one more question which just feeds into this whole discussion, is how does it matter for the corporate P&Ls and ROEs? And this whole super cycle is going to bring back ROEs to where they were in the previous cycle, because it's a synchronous cycle. It's like 50,000 people leaving a football stadium at one point versus people leaving 1,000 at a time in a disciplined way. So the whole world in April was down and beaten and battered, and the whole world is trying to come out of it. As you do that, this is a 2-3 year play out of a synchronous recovery. Like 50,000 people leaving a football stadium, it takes time for everyone to leave, and there's a bit of a jam and there's pressure and people push each other for resources. I think that is something we're going to see over the next year or so. And I think that's extremely positive for corporate P&Ls, for ROEs, and markets in absolute. So we're very constructive and bullish, and we need to keep that optimism and find near-term concerns like the US elections or COVID-related concerns as opportunities to buy in.
Well, this was lovely. I don't know how often you write, Jeetu, but the next time you write a note, do send it to me, and we would love to study it and talk to you again, or even otherwise, of course. But thank you so much for speaking to us today on Navigating Through Uncertainty.
Thank you, Neeraj. Thank you for having me on the show.
And the pleasure was ours. Happy festivities.
Thank you. Likewise.
Thank you. And viewers, thanks for tuning into this edition of Navigating Through Uncertainty.